Hi, everyone. Welcome back to another episode of Gate Pass Market Monday. Hope everyone had a great weekend. We're going to hop right into it for this week. So things escalated pretty quickly on Wednesday over fears that inflation is going to be stickier than expected and interest rates are going to be kept higher for longer. So as expected, the Federal Reserve cut interest rates 0.25%, but that was really overshadowed by the forward-looking commentary from Jerome Powell that was pretty hawkish. So if we just go back to the Federal Reserve meeting in September, the Federal Reserve set policy rates for 2025, essentially saying that they're going to cut four times for a total of 100 basis points or 1%. On Wednesday, they essentially slashed that in half, saying they're probably only going to cut two times now for a total of 0.5%. And that really spooked a lot of investors and caused a sell-off on Wednesday and Thursday. So the big theme going into 2025 now is going to be around the direction of interest rates and where inflation is heading. And this can have significant impact on portfolio construction and asset allocation decisions as well, given if the risk-free rate is higher, investors are going to have to pick and choose where they want to be because that's going to set a higher bar for equity returns. So for example, if an investor had some either cash or fixed income earmarked to go back into the equity markets, but now rates are going to be higher, they may keep that either in traditional fixed income or private credit and not allocate it back to the equity markets. That being said, calmer heads did prevail by the end of the week on Friday. We saw a little bit of a relief rally as the core PCE number, which is another inflation metric that the Federal Reserve looks at, came in better than expected. So to us, we actually rather be in an economy that's strong with a little bit of inflation than the complete opposite, which is essentially no growth and no inflation at all, right? And we talked about this many times before, but 70% of the economy comes from the consumer and consumption, right? And where does consumption and the consumer come from? That's coming from income, right? And where does income come from? That comes from a solid labor market, whether it's business ownership or W-2 employment. And when you look at the labor market right now, it's fairly solid. When you look at the personal balance sheets for individuals, they're pretty solid right now. So we feel that the economy is in a spot that can do pretty well, even if interest rates are going to be higher for a little bit longer. And yes, there's going to be some sectors that are going to be adversely affected, like housing. So not all sectors are going to do well with higher interest rates. But the Federal Reserve is still planning to cut interest rates next year. It's just at a slower pace than they originally anticipated. But to us, there's still a lot more positives out there than negatives. And let's not forget, I mean, the equity market's having a great year thus far. And if we do see some volatility or a little correction, that's perfectly normal in the course of market activity. And let's not forget also, and it's worth noting as we close things up, today marks the beginning of the Santa Claus rally, which essentially on a calendar year basis, historically have been the strongest 2 weeks for equity returns. So time will tell if the Federal Reserve played Grinch on the 2024 Santa Claus rally, but overall, we still feel there's still a lot of positives out there. The positives outweigh the negative. The consumer still remains intact. So yes, interest rates may be coming down slower than expected, but we think the overall economy is still doing very well. So we'll end things there for this week. I just want to say I hope everyone has a great holiday season with friends and family. I hope everyone can unplug for a little bit from work and come back rejuvenated for 2025. So we'll be back next week for our last episode of the year, which is crazy to say, but we really appreciate everyone dialing in this year, and we'll see you next week. Thanks.